Warren Buffett, often referred to as the Oracle of Omaha, is hailed as one of the most successful investors in history. His journey began modestly enough in Omaha, Nebraska, but his savvy investing strategies and steadfast principles quickly propelled him to the forefront of the financial world. Buffett's investment company, Berkshire Hathaway, is a testament to his success. From its humble beginnings as a struggling textile company, Berkshire Hathaway has grown into a multinational conglomerate holding company, boasting an impressive portfolio of businesses across various sectors. Its extraordinary growth over the years is largely attributed to Buffett's unique approach to investing. His strategy, marked by a keen understanding of risk management and an unwavering commitment to long-term investing, has not only yielded substantial returns, but also earned him the admiration and respect of investors worldwide. Now, let's delve into the principles that underpin Buffett's approach to risk management. First on the list is the concept of margin of safety. Now, what does that mean exactly? Well, it's a principle that guides an investor to buy assets when their market price is significantly below their intrinsic value. It's like buying a dollar for 50 cents. This difference creates a safety net or buffer for investors against unfavorable outcomes or errors in judgment. Warren Buffett, the Oracle of Omaha, is a big proponent of this strategy. He doesn't just buy any stock. He looks for companies with strong fundamentals, businesses he understands, and most importantly, those that are undervalued. He patiently waits for opportunities to buy these quality businesses at a price that offers a margin of safety. This approach gives him and his company, Berkshire Hathaway, a cushion against potential losses if the investment doesn't pan out as anticipated. But how do you determine a company's intrinsic value? Well, it's not as simple as looking at the stock price. It involves a deep understanding of the company, its financials, and the market it operates in. It's about making reasoned estimates of the business's future cash flows and profits. It's more of an art than a science, and it requires patience, discipline, and a good deal of homework. By investing with a margin of safety, Buffett mitigates the risk of permanent capital loss. It's like having an insurance policy against the unpredictable nature of the stock market and the inherent risks of investing. The second principle is understanding risk. Now, this is where Warren Buffett's approach really shines. He emphasizes the importance of understanding the risks associated with an investment before you dive in headfirst. It's not just about the potential gains, but the potential losses as well. Buffett isn't one to shy away from the details. He dives deep into the research, studying the ins and outs of the company, the industry it operates in, its competitive advantages, the management team at the helm, and the potential risks that could impact future performance. This rigorous analysis is not for the faint-hearted, but it's essential in making informed investment decisions. It's like getting to know someone before you marry them. You wouldn't just look at their smile and decide to tie the knot, would you? You'd want to understand their character, their habits, their values. Similarly, understanding a business and the risks involved in investing in it allows you to make a decision based on more than just surface-level information. But it's not just about avoiding the bad apples. Understanding the risks also helps you identify opportunities that others may overlook. This level of understanding can lead to finding gems in places where others see only stones. So in essence, understanding risk is about more than just avoiding pitfalls. It's about making the most out of your investments and turning stones into jewels. Understanding the risks allows investors to avoid investments with unacceptable levels of risk. Thirdly, Buffett believes in diversification. Now, diversification is a term we've all heard before, right? It's the practice of spreading your investments around to reduce risk. But Warren Buffett's approach to diversification is a little different from the textbook definition. Buffett, while acknowledging the importance of diversification, cautions against over-diversification. He suggests that investors often make the mistake of spreading their investments too thin, resulting in diluted returns. So, how does one strike the right balance? Well, according to Buffett, it's about focusing on a few high-quality investments. In Buffett's own words, diversification is a protection against ignorance. It makes very little sense for those who know what they're doing. So, rather than scattering your investments far and wide, Buffett encourages investors to focus on companies within their circle of competence. This means investing in businesses that you understand and believe in, businesses that have strong fundamentals and a bright future ahead. But remember, diversification in Buffett's playbook is not about playing it safe. It's about making informed, intelligent investment decisions. It's about knowing your investments as well as you know the back of your hand. It's about conviction, confidence, and, above all, competence. Diversification, when done right, can provide a safety net against potential losses. But remember, it's not just about spreading your investments, it's about understanding where you're putting your money. Because at the end of the day, knowledge is the best investment you can make. Lastly, Buffett advocates for a long-term perspective. This means that he's not swayed by the ebb and flow of market trends or short-term volatility. Instead, the Oracle of Omaha focuses on the underlying fundamentals of businesses and chooses to invest for the long term. He believes that the true value of a company isn't reflected in its daily stock price movements, but in its long-term performance and growth. This approach shields him from the emotional highs and lows that can often accompany investing. When the market is in a frenzy, either in a bullish surge or a bearish decline, Buffett remains steadfast. He does not allow short-term market fluctuations to dictate his investment decisions. Now you might wonder, what's the benefit of such an approach? Well, by investing for the long term, Buffett gives his investments the chance to truly flourish. He allows the magic of compounding to take its course. Compounding, often described as the eighth wonder of the world, works best over extended periods. So, by keeping a long-term perspective, Buffett ensures that his investments have the time they need to grow and compound. This approach not only reduces the impact of short-term market fluctuations on his portfolio, but also maximizes his potential returns. By taking a long-term perspective, Buffett allows his investments to compound over time.